Hello everyone, welcome back. In today's video, we're going to be going over some dividend ETFs that are probably not the best idea to buy for various different purposes. A lot of these ETFs, it seems that people just chase yield and they are so focused on income that they are basically not looking at the investment from a bird's eye view. So we're going to go into why these ETFs are bad and maybe some alternative ETFs in case you do want a high dividend yield with capital appreciation. And before we get started, please consider liking and subscribing for future content. So the first ETF we have is QYLD. This isn't so much of a dividend ETF, rather an income ETF. It does pay a high dividend yield around 12%, and it is the Global X NASDAQ covered call ETF. So as you can imagine, the fund makes its income by selling covered calls. So the main premise of this ETF is that it seeks to generate income through covered call writing, which historically produces higher yields in periods of volatility. So in other words, if volatility in the market is high, this will provide you with greater income, and when volatility is low, that option income will decrease, that premium that you receive, and you'll receive less income overall. So the QYLD ETF writes covered call options on the NASDAQ 100 index. So the idea is that it saves investors the time and potential expense of doing so individually. So the alternative to that would be owning QQQ outright, for example. Of course, QQQ isn't the NASDAQ 100 itself, but it tracks the NASDAQ 100, and then just sell covered calls on QQQ around a month out. So in long, the Global X NASDAQ 100 covered call ETF follows a covered call or buy white strategy in which the fund buys stocks in the NASDAQ 100 and writes or sells corresponding call options on the same index, and it seeks to provide the same investment results that correspond generally to the price and yield performance before expenses of the CBOE NASDAQ 100 buy right V2 index. To get a little bit more precise, I opened up the fund details page, kind of the more in-depth fact sheet about this ETF, and the ETF sells a succession of 1 month at the money NASDAQ 100 index covered call options. So if the NASDAQ is, let's just say for example, trading at $300 per share, again I'm just using that as an example. I know the NASDAQ isn't an ETF, but I'm just using it as an example. If it's trading at $300 per share, then the fund will sell a covered call 1 month out at $300 per share. And of course, the good thing about this is the income you will receive is quite high, and the dividend yield will be quite high too, at around 12% again. And also the income will be consistent. It does pay monthly, sometime around the last week to the first week or so of every single month, and that will be consistent. Now, the problem with this strategy is that covered calls will limit your capital appreciation. Of course, with the covered call, you have the obligation to sell those shares at that specific price if it goes over that price. So if this goes to, example, $301 a share, the NASDAQ, it will be obligated to sell its holdings, and then you'll still receive the income, but you're not going to receive the capital appreciation. So if it not only goes to like $301 a share, but it goes to $310 a share, well, that's too bad for you as an investor, because you're obligated to sell your shares at $300 a share, which will limit that capital appreciation. And here I have the 5-year chart of this ETF, and you'll see that over time, this capital will decrease and decrease and decrease because, of course, generally the NASDAQ will go up. And we can compare that to how QQQ performed, which again is an ETF that tracks the NASDAQ 100. And you see that it appreciated, of course, and it completely outperformed the fund in capital appreciation. Now, a lot of people may think that, hey, well, I could just reinvest these dividends and my total weighted return, my total return will be still very good with those dividends reinvested. Of course, if you're losing capital, but you just reinvest those dividends, it may make up for that capital depreciation. However, what you'll find out if you do invest in this ETF, and I really hope you don't for the reason I'm about to say here, is that even with those dividends reinvested, you will not perform any better than QQQ or many other dividend ETFs. So here I have the very common dividend investor favorite, SPHD, or the Schwab US Dividend Equity ETF, and I pitted that against the NASDAQ Covered Call ETF, which I just spoke about, QYLD, and this is since 2014, let's call it, just right there. And you'll see that despite that high dividend it pays, the fund SPHD, which uses a much more conventional method than QYLD for dividends, completely outperforms QYLD. So this is more of a pure income play rather than it is a capital appreciation play. You will lose your money over time if you don't invest those dividends, reinvest those dividends. And even if you do, you will not outperform many other popular dividend investments. And that is going to be it for describing this ETF. I hope I gave you a little bit of a good overview of this ETF and why you should not invest in it if you are an income investor. And before I completely move on, because other ETFs kind of use this strategy, another ETF that does this 1 month out at the money covered call style options income is XYLD, and that is the Global X S&P 500 covered call ETF. It employs pretty much the same strategy, but instead of the NASDAQ, it does it on the S&P 500, and you'll see it is basically plagued by the same problem. And if I do a portfolio back test, which I'm not to save some time, you will see that this will also lose capital over time, and you will also not outperform other popular dividend ETFs. Next up, we have SPHD, or the Invesco S&P 500 High Dividend Low Volatility ETF. It does pay around 4.4% or so, and if you do look at it, it does outperform QYLD in terms of capital appreciation by a wide margin. And if you were to pick one or the other, I would definitely choose SPHD as my poison over QYLD, but this really isn't a good ETF to invest in. I personally was invested in this ETF, but for reasons I described in another video, which I'm really not going to get into in this video, I sold this ETF for JEPI instead because this ETF's investment methodology I think is pretty bad. So similar to QYLD, this ETF also does pay monthly, and if you're looking for a monthly payer and you do want that really high yield, again, me personally, I would go for JEPI instead of SPHD, but I would much rather prefer anybody watching this video invest in SPHD than QYLD instead, because this ETF is just going to simply outperform. This ETF's investment methodology is a lot more conventional. So the investment methodology that this ETF uses is that it invests in the less volatile stocks of large cap companies and invests in dividend paying stocks of companies. It seeks to track the performance of the S&P 500, a low volatility, high dividend yield index. So what it does, this index, is that it basically measures the performance of the 50 least volatile, high yielding constituents of the S&P 500 index in the past year. In the most simple terms, the fund basically picks the highest yielding dividend stocks of the S&P 500, measures them based on volatility, and then that is your ETF. Which, again, really isn't too bad of a premise because you're getting that diversification. A lot of people chase yield in one holding itself, but at least with this one, you have your holdings diversified into 50 companies. However, with that yield chasing, you are going to get underperformance. Again, I paired this ETF up against the SPHD ETF, and we see that SPHD, even with the dividends reinvested into it, definitely underperformed the very popular SPHD ETF. So this ETF, again, is going to perform better than QYLD and XYLD and some other option strategy ETFs, but this ETF is still going to underperform ETFs that do try to pick dividend stocks based on quality instead of just yield alone. And that's going to be it for SPHD. And I also want to add in another ETF that kind of does a similar investment methodology like I did before with QYLD and XYLD. A similar investment methodology is this Spider Portfolio S&P 500 High Dividend ETF. It instead basically pays quarterly and has a very slightly different investment methodology, and it's also provided by a different company. But who provides these ETFs, or even really the ticker symbols, doesn't really matter quite as much. It's basically these types of ETFs and these investment methodologies. So this ETF 2 SPYD also does significantly underperform SCHD by a wide margin. Again, all of these ETFs don't really screen for quality. They're just going for yield itself, and there's really not much else to it. It's basically a thoughtless yield chasing kind of investment methodology. And I guess for some people that will work. Again, SPHD isn't the worst ETF, especially in your retirement age, and you need that just steady, constant monthly dividend payment, but it is not going to grow in capital whatsoever, generally over time. And if there is one ETF that I hope you all have nothing to do with, it is the YieldMax Tesla Option Income Strategy ETF, TSLY. It does pay an incredible yield because it is an option strategy on a volatile stock. And again, as I basically said with QYLD, options income increases in higher volatility environments or higher volatility holdings. And since Tesla is a high volatility stock / holding, you're going to see an incredible yield. So this ETF hasn't been around for too long, which is probably a good thing because it hasn't made many people broke yet, I suppose. The good thing is like the other ETFs, it does pay monthly. It pays around the middle of every single month consecutively so far. But that's pretty much where the good ends. And as you can see, since its inception, it has just declined and declined and declined. It is now down in capital and price around a 44%. So had you have held it since, looks like it came out in inception in November of 2022, you'd have lost about half of your capital so far. But again, people say, oh, well, you know, it's not so bad. I can just reinvest those dividends and I'm getting all of that yield. I'm probably making so much money and I really don't care about the capital because I'm reinvesting it and then my total return is going to be great, right? And actually, with this ETF, unlike QYLD and XYLD, this ETF, because of its short history, is actually an example of a covered call ETF doing very well in a short amount of time compared to other dividend ETFs. This ETF, TSLY, completely outperformed SCHD by a huge margin. Now again, this is a very short history, with there only being about a year or so of trading under its belt. So it's really not a good idea to base the entire history of this ETF or how this will perform on a single year. But this ETF actually has performed decently well over the past year. And this is probably because the ETF isn't strictly a covered call ETF at the money. In other words, it doesn't sell options at the money. So if Tesla is trading, for example, at $100 per share, it won't sell a covered call at $100 per share. It'll sell it at, let's just say, $110 a share. So you will get some of that capital appreciation. And Tesla absolutely has increased in capital so far. So over the past year at least. So you can definitely see the power of that ETF and also the benefit of a short history. But let me tell you something. If this stock does anything other than go up, it is not going to be pretty. I don't think this stock is really going to go up that substantially from here, but I don't know. I think it could be $1 trillion market cap like it was before, but it could definitely go down more. And if it drops 50%, that covered call is not going to help you whatsoever. And in fact, the ETF actually says, the ETF fund page actually says a couple different things here. It says that returns in short-term performance in particular are not a good indication of the fund's future performance. So again, the fund itself is even saying, and I mean, to be fair, every investor probably knows that, but just because this fund has performed well over the past year, it doesn't mean that it is going to perform well going forward. And it even says that the ETF will be highly dependent on the performance of Tesla. The fund strategy is subject to all the potential losses of Tesla shares decrease in values, which may not be offset by the income received by the fund. And the fund strategy will cap the potential gains of Tesla too. So if you're a Tesla bull, I don't know if this is going to be the best ETF, because why not just buy Tesla if you think it's going to go up? And if you are a dividend investor or an income investor, I don't know if this is going to be the best strategy because of the lack of diversification. And Tesla itself is a growth stock, and most dividend investors like myself, we don't want volatility, and this stock is highly volatile. So I don't think this is the best investment. And again, just like the other ETFs, the comparison ETF would be like the YieldMax Amazon ETF, which employs a similar strategy, except that it is on Amazon stock. So I would also not recommend investing in AMZY either. I mean, I guess if you think that these stocks are going to trade sideways, they will, definitely provide you good income. But I think the lack of diversification and, that those volatile stocks are just not a good combination for these ETFs. So if you want some yield, what can you do? We just went over a host of stocks with high yield, and I covered my dividend strategy, my dividend kind of pie in a separate video. But I basically pair SPHD, which is that quality dividend ETF that I pitted against all those other ETFs that I just reviewed, and I paired that with JEPI, a high yield ETF that is basically also a covered call ETF, but it uses exchange-linked notes instead, and the holdings it has are a little bit different, and the covered calls that it sells aren't really at the money either, especially because it uses exchange-linked notes and not strictly covered calls. So this provides me with a great yield with also the potential for some good capital appreciation. So that's going to be it for today's video. I hope I did kind of inform you about some ETFs to avoid. Maybe you already did avoid some of these ETFs and you knew that they weren't really good. Or maybe you were considering investing in these ETFs due to their yield. And I do hope maybe that I steered you away from these ETFs, or at least informed you about why I don't think it is the best idea to invest in these ETFs, and there are some better options. So again, I want to thank you all for watching. I really appreciate it. And again, please consider liking and subscribing for future content, and I will see you all in the next video.